You twist the key in a rental's front door, and the deadbolt snaps back with a sound that feels too loud in the empty hallway. Outside, cold wind scrapes dry leaves across the sidewalk, and a low gray sky hangs like a lid, heavy, pressurized, impatient. The "For Rent" sign out front is already sun-faded, corners curled from weeks of weather, and you can almost hear the silence inside the building. No footsteps, no moving trucks, no new leases. This is 2026's rental market mood, tightened by higher interest rates, flooded by new supply, and suddenly turning renter-friendly in the places that used to feel bulletproof. Landlords are cutting prices, stacking concessions, and watching vacancy climb, like water, creeping up a basement wall. In this countdown, you'll travel through 10 U.S. cities where rent is collapsing, and the panic gets worse with every stop. Subscribe to Market Pulse Real Estate now, because the final city is where the real cliff edge appears. Number 10, San Antonio, Texas. You roll past the Riverwalk's warm lights and Spanish colonial facades, a city long seen as steadier than its flashier Texas neighbors. San Antonio used to feel like the safe rent market, until the numbers started turning, quietly at first, then consistently. In the pandemic surge, demand spilled in from pricier metros, and by 2022, rents and values were riding a growth wave powered by population gains and new development across the outskirts. Now the slip is measurable. Realtor.com's November 2025 rental data shows the San Antonio Metro's median asking rent for 0 to 2-bedroom units at $1,207, down 2.7% year over year, while the national peak was $1,735 in November 2022, a reminder of how inflated the era became. Source Zillow's rent report shows San Antonio's typical rent, Zori, around $1,360 with 0.6% month-over-month movement, and more than half of listings showing concessions in late 2025. Source Redfin also shows the for-sale market softening. The median sale price was about $268K, down 2.7% year over year, with homes taking roughly 47 days to sell and sale to list near 97.3%. Source 2 forces pinch landlords hardest. An ongoing wave of delivered apartments and Texas cost pressure. Property taxes near were 2% in counties like Bexar, plus rising insurance and maintenance costs that don't fall just because rent does. As you leave San Antonio behind, the market feels less balanced and more like a rope fraying, still holding, but clearly unraveling. Number 9. Houston, Texas. You enter Houston under sprawling freeway overpasses, billboards glowing through humid haze. For years, Houston's reputation was endless space, endless demand, and landlords banked on steady household growth. Now, the supply story is catching up. The market's modern peak came in the 2021-2022 run-up, when migration and job growth lifted rents and values, and investors treated Houston as a scale play. Buy more doors, raise more rents. Today, the cooling shows up in both rent and stress signals. Realtor.com's November 2025 rent data lists the Houston Metro's median asking rent at $1,369, down 2.7% year over year. Source Zillow's rent report shows Houston's typical rent, Zori, around $1,617, essentially flat year over year, but with 47.8% of listings offering concessions. Nearly 1 in 2 landlords blinking first. Source. Meanwhile, foreclosure pressure is ticking up nationally, and Adams' year-end 2025 report lists Houston among the large metros with the highest foreclosure starts, 13,009 in 2025. Source. That adds a darker undertone. More distressed owners competing with rentals, more uncertainty, cost headwinds intensify it. Property taxes in counties like Harris remain high by national standards, with effective rates often cited around or 1.7%. Source add insurance volatility and maintenance inflation, and landlords are squeezed from both ends. As you move on, Houston's market doesn't look soft. It looks like pressure building under the pavement, ready to crack. Number 8. Las Vegas, Nevada. You arrive with neon bleeding into the desert night, the strip still loud, but the rental market underneath is losing rhythm. Las Vegas was once the symbol of fast recovery and fast rent growth, until the post-pandemic expansion turned into oversupply. At the peak of the frenzy, around 2022, Vegas drew remote workers, investors, and Californians chasing cheaper housing, and rents surged with demand. Now the reversal is sharper. Realtor.com's November 2025 rent report shows Las Vegas metro median asking rent at $1,434, down 3.0% year-over-year. Source Zillow's December 2025 rent report shows Las Vegas typical rent, Zori, around $1,723, with 51.6% of listings carrying concessions, and Las Vegas listed among metros with some of the biggest year-over-year increases in concession prevalence. Source: The distress backdrop is also troubling. Adams' 2025 foreclosure report ranks Nevada among the worst foreclosure rate states and lists Las Vegas with a metro foreclosure rate of 1 in 210 housing units. Source: When foreclosures rise, investors pull back, listings increase, and rent competition turns brutal, especially in investor-heavy neighborhoods. As you drive away from Vegas, the glow feels colder. The market isn't just cooling, it's crumbling like stucco in dry heat, and the next cities are worse. Number 7. San Diego, California. You crest the freeway and see ocean haze rolling over palm tops, a postcard city that's always felt too desirable to break. For years, San Diego's reputation was high rent, low vacancy, unstoppable demand. But even paradise can hit an affordability wall. San Diego's peak era was 2021-2022, when remote work and coastal scarcity pushed renters into bidding wars and landlords held all the leverage. Now the math turns against them. Realtor.com points to the San Diego Metro's median asking rent at $2,788, down 3.5% year-over-year in November 2025, one of the steep declines among large metros. Source: Zillow's December 2025 rent report still shows San Diego's typical rent, Zori, around $2,989, but the affordability strain remains severe. Roughly 30.0% of median income needed for the typical rent, and 39.5% of listings offering concessions. Source: On the ownership side, Redfin shows the median sale price around 1.0 million, with homes selling in the 60-plus day range recently. Momentum that isn't as hot as it was. Source: San Diego migration also links strongly with outflows from LA. The problem: when affordability breaks, demand doesn't vanish. It relocates inland or out of state. New deliveries and concessions turn premium into negotiable. As you leave San Diego, the coastline still shines. But the rental market underneath is quietly collapsing, like cliffs eroding grain by grain. Number 6. Phoenix, Arizona. You drive into Phoenix under a bleached sky, heat shimmering on asphalt. This city became the emblem of the Sun Belt boom, fast growth, fast rent increases, and a belief that demand would always outrun supply. That belief is now cracking. Phoenix peaked in the pandemic-era frenzy, 2021 to 2022, fueled by inbound migration, investors, and remote workers moving from the coast. Then the pipeline delivered. Realtor.com's November 2025 rent report shows Phoenix metro median asking rent at $1,445, down 4.0% year-over-year. Source: Zillow's December 2025 rent report shows Phoenix typical rent, Zori, around $1,728, with 0.5% year-over-year movement and 58.3% of listings offering concessions, more than half the market trying to buy demand back. Source: Even affordability metrics underline pressure. Phoenix renters needed about 21.9% of median income for typical rent, and that still isn't cheap once wages and inflation are considered. Source: Supply plus investor pullback is the combination that turns cooling into troubling. Once renters learn they can negotiate, pricing power evaporates. As you head out of Phoenix, It feels like the market is sunbaked and splitting, hairline fractures spreading through what used to look solid. Number 5. Jacksonville, Florida. You reach Jacksonville, with salty air pushing in from the Atlantic, clouds thickening like a storm line. Florida's rental story used to be relentless demand. But in Jacksonville, the pressure is shifting from hot to genuinely alarming. The city surged during 2020-2022 as remote work and affordability seekers poured in, and landlords raised rents fast while investors snapped up single-family rentals. Now the turn is visible in the data. Realtor.com's November 2025 report lists Jacksonville metro median asking rent at $1,457, down 4.2% year-over-year. Source Zillow's December 2025 rent report shows Jacksonville's typical rent, Zori, around $1,659, with 46.8% of listings offering concessions, nearly half the market. Source foreclosure stress is rising too. Adam lists Jacksonville among large metros with one of the worst foreclosure rates at 1 in 200 housing units. Source. That's a flashing warning sign for landlords relying on high occupancy. Florida adds a unique crusher, insurance, and climate risk. Statewide property insurance costs remain a defining factor. U.S. Census data shows Florida had the nation's highest median property insurance cost for mortgaged homes at $2,273. Source. As you leave Jacksonville, the market feels like a shoreline before a hurricane. Water pulling back, tension rising, and the collapse gaining speed. If you're finding this data-driven analysis useful, like the video and comment which city surprises you most. Your engagement helps us continue this research. Number 4. Birmingham, Alabama. You roll into Birmingham beneath a steel gray sky, old brick factories and fresh redevelopment sharing the same streets. Birmingham is often seen as affordable America, the refuge when bigger cities get too expensive. But even affordable markets can break when demand softens and supply loosens. The early 2020s push brought renters chasing lower costs and investors hunting yield in cheaper single-family rentals. Now, the data is turning troubling. Realtor.com's November 2025 rent report shows Birmingham's median asking rent at $1,180, down 4.6% year-over-year. Source Zillow's December 2025 report shows Birmingham's typical rent, Zori, around $1,375, and concessions are spreading. Birmingham is listed among metros with the largest year-over-year increases in the share of rentals offering concessions. Source. That matters because in lower rent markets, even small dollar drops can wipe out cash flow margins. When concessions go mainstream, the market psychology flips. Tenants wait for deals, renewals get discounted, and rent growth doesn't just slow, it collapses. As you pull out of Birmingham, the market feels like old masonry under stress. First a crack, then a widening seam, then a whole wall starting to bow. Number 3. Miami, Florida. You enter Miami under bright sun and fast-moving clouds, a city that looks like wealth, until you look at the carrying costs. Miami's image was unstoppable demand, an inflow magnet during the remote work era. But 2026 is exposing how fragile that story becomes when expenses spike. Miami's peak heat ran 2021-2022, when high-income movers and investors bid aggressively, pushing rents and prices upward. Now the strain is brutal. Realtor.com's November 2025 data shows Miami metro median asking rent at $2,287, down 2.7% year-over-year. Source Zillow's December 2025 report shows Miami's typical rent, Zori, around $2,752, but affordability is crushing. About 37.4% of median income needed to afford the typical rent, one of the least affordable major metros. Source foreclosure starts are also high. Adam lists Miami with 8,936 foreclosure starts in 2025 among large metros. Source. But the real hammer is insurance. Miami-Dade condo unit insurance premiums rose almost 40% over a measured period, according to WLRN reporting. Cost inflation that landlords can't rent-raise their way out of anymore. Source: as you leave Miami, it feels like a luxury tower with flooding in the basement, glitter above, damage below, and a market starting to collapse from the inside out. Number 2, Denver, Colorado. You arrive in Denver with cold air cutting sharp and dry, mountains crisp in the distance. Denver used to be the always tight rental market, high demand, limited supply, and confident landlords. That era is ending fast, and what replaces it is alarming. Denver's peak heat was the 2021-2022 run, when migration and job growth collided with limited inventory and rents surged. Then, the building wave hit. By late 2025, the oversupply became undeniable. The Colorado Sun reports more than 34,000 apartments sitting empty, pushing the vacancy rate to 7.6%, the highest in 16 years, with average rent down 4.8% to $1,754, and concessions averaging 169 or 9.5% of gross rent. Source: Realtor.com's November 2025 rent data shows Denver metro rent down 4.8% year-over-year at $1,742. Source: Zillow's December 2025 report shows Denver's typical rent, Zori, about $1,856, and a staggering 67.5% of listings offering concessions, 2 out of 3 landlords negotiating. Source: oversupply plus slower population growth turns cooling into collapse. When everyone discounts, the whole market reprices downward. As you drive away, Denver feels like a ski slope after an avalanche. Beautiful, but unstable and sliding. Number 1, Austin, Texas. You cross into Austin under a sky that can't decide between storm and sun, and it matches the market perfectly. Volatile, restless, and suddenly dangerous for landlords. Austin was the poster child of the boom: tech migration, remote work, and rents that felt like they'd never stop climbing. 2026, Austin is the most devastating reversal on this list. Austin's frenzy peaked in 2022, when landlords priced as if demand was permanent, and investors treated every lease-up like guaranteed profit. Now, the breakdown is stark. Realtor.com's November 2025 rent report puts Austin Metro median asking rent at $1,288, down 6.6% year-over-year, one of the steepest declines among the largest metros. Source: Zillow's rent reporting shows Austin among metros with the biggest annual rent drops in late 2025, and concessions are widespread. Source: nationally, the rent peak was $1,635 in November 2022, and many boomtowns are now below that ceiling. Austin is leading the drop. Source: on the for sale side, Redfin shows Austin's median sale price around $560K, with 4.6% year-over-year, sale to list near 97.1%, and homes taking about 49 days to go pending. Clear evidence that pricing power has weakened. Source: this isn't just supply, it's a full reset. A flood of new units, higher interest rates, and tech sector uncertainty together make landlords hemorrhage leverage. As you leave Austin behind, the market doesn't feel cool. It feels like it's collapsing in real time, and the path forward is years of rebuilding, not months. We just counted down from mild cracks to full structural failure. Cities where rents are falling, concessions are exploding, and landlords are fighting for tenants instead of the other way around. Across these markets, the same crisis theme repeats. Post-pandemic building waves collided with higher rates and affordability ceilings, and the result is a renter-friendly shock that's forcing brutal repricing. Source: if you own rentals in any of these metros, treat 2026 like a risk management year. Protect occupancy, tighten expenses, and stop assuming last decade's demand will save you. Subscribe to Market Pulse Real Estate, hit like, and comment which city you think hits bottom first, because the next data update could redraw the map again. This is Market Pulse Real Estate signing off.